Heading toward the morass of slumpflation. Anthony P. Mueller. The term slumpflation was coined to characterize an economy where an economic slump appears together with price inflation. In such a constellation, macroeconomic stimulus policies do not work. Nevertheless, government policymakers and central bankers, not only in the United States, have launched massive programs of expansive economic policies. Continuation of ZIRP. On June 10, 2020, the Federal Reserve System, Fed, which acts now more as a branch of the U.S. Treasury than as an independent central bank, announced to continue its zero interest rate policy, ZIRP, with the aim to support the recovery of the U.S. economy from the consequences of the lockdown in response to the coronavirus pandemic. In early June 2020, the American Central Bank holds assets in the amount of $7.17 trillion US. Figure 1. Figure 1, Balance sheet assets of the U.S. Federal Reserve System. As the figure. Figure 1, Balance sheet assets of the U.S. Federal Reserve System. As the figure, Fig 1, shows, the Fed had tried from 2015 to late 2018 to trim its balance sheet when it had brought down the amount of its assets to $3.8 trillion in August 2019. Yet beginning already in September 2019, many months before the lockdown was implemented, the assets of the American Central Bank began to rise again and reached over $4 trillion before the additional big increase happened due to the fallout from the lockdown. In the weeks before its recent announcement quoted above, the U.S. Central Bank had already expanded its money supply to over $7 trillion. Thus, the Federal Reserve System resumes the policy that it implanted after the outbreak of the financial crisis of 2008. Back then, the assets of the balance sheet of the Federal Reserve System rose from $870 billion in August 2007 to $4.5 trillion in early 2015. It is quite significant that the U.S. Central Bank had to keep its tampering small and refrained from further tightening towards the end of 2019. The monetary authorities have given up on the objective to rein in the money supply. Anytime they tried to do so in a significant way, the stock market signaled a tendency to crash. It seems that warding off a deflation of the asset bubble has become the prime objective of monetary policy. Falling into the slump. Monetary authorities have released a huge amount of money in the form of central bank money, called monetary base, to mitigate the consequences of the economic contraction due to the lockdown. While the American Central Bank boosts the money supply, the economy is shrinking, and unemployment is on the rise. According to the second estimate released by the Bureau of Economic Analysis, the U.S. real gross domestic product, GDP, decreased 5% in the first quarter of 2020, Figure 2. Figure 2, U.S. real gross domestic product. Quarterly changes, 2016 to 2020, Q1. Source. Figure 2, U.S. real gross domestic product. Quarterly changes, 2016 to 2020, Q1. Source, BEA. After a long decline of the unemployment rate that brought the U.S. economy close to its full employment level of 3% in 2019, unemployment rose sharply in the beginning of the crisis and settled at an official rate of 13.3% in May 2020. Figure 3, U.S. unemployment rate 2010 to May 2020. The lockdown of the economy has favored a few sectors while most other parts of the economy will suffer, particularly such labor-intensive areas as the restaurant business and tourism. Because of this, unemployment will persist and macroeconomic policy must fail. The private sector is largely paralyzed, and new long-term investment projects have almost all been stopped because the planning horizon has shortened. Fiscal expansion boosts public debt. Along with the monetary policy, fiscal policy, too, has become highly expansive. Confronting the sharply rising unemployment, the U.S. government began to raise its expenditures. While already burdened with a high level of public debt, which had brought the ratio of public debt to gross domestic product to 107% in 2019, the indebtedness of the U.S. government got a further increase since March 2020 that has lifted the overall public debt of the U.S. government to $25.75 trillion in May 2020, Figure 4. Figure 4, U.S. public debt May 2019 to May 2020. Figure 4, U.S. public debt May 2019 to May 2020. Source, Statista. While the public debt is rising, the economy is shrinking. As a consequence, one must expect a sharp increase of the debt ratio in the years to come. 2020 is not 2008. The monetary and fiscal authorities, together with large parts of the financial community, seem to believe that the current measures are simply a remake of policies that were adopted after the crisis of 2008 and that this time, too, no significant price inflation would result from the expansive measures. It is calamitous for both policymakers and investors, however, to ignore the difference between 2008 and 2020. In the aftermath of the financial crisis of 2008, the stimulus policies did not turn into a price inflation because the newly created money remained to a large extent in the financial sector. The main effect of the policy of low interest rates was to support the stock market and provide a windfall to financial investors. While Wall Street flourished, Main Street was left on the sidelines, and while profits surged, wages remained stagnant. The difference of 2008 to 2020 is that the economic consequences of the lockdown affect the real economy. Unemployment is likely here to stay, and it may take a long time for the economy to recover. The crisis of 2008 left the capital structure of the real economy intact. In 2020, this is not the case. The present situation is more similar to the blow that came with the oil price shock in 1973. At that time, the efforts to stimulate the economy by fiscal and monetary expansion produced a long-lasting stagflation. Back then, along with stagflation, the term slumpflation was coined to more accurately characterize an economy that is mired in a deep slump and gets devastated by price inflation. When stagnation and recession show up together with price inflation, macroeconomic policy has hit the wall. Using Keynes as the guide for fighting the downturn would give an additional blow to the economy, which has already been weakened by the pandemic and the consequent lockdown. A third blow is now about to hit economic life because of the economic policies intended to cure the impact of the preceding two hits. The crisis of 2008 destroyed not real but financial capital, and the central bank healed these losses by creating the massive amount of liquidity. This time, however, the real economy is shrinking, and real capital is being destroyed. Additional government expenditures and monetary expansion must fail to stimulate the private sector when the economy is challenged by the pervasive necessity to achieve its adaptation to the new situation. 2020 is not the hour of macroeconomic policies but a call for entrepreneurial action to arrange the capital structure in the face of the changing demand pattern. With the global supply chains in disarray, and national protectionism on the rise, the help that came from international commerce after the crisis of 2008 is no longer here. The lockdown of the economy has severely hurt the global system of supply chains that had been a major source of keeping prices low in the past. Additionally, with the rupture of the trade with China that concerns not only the United States, the impact of cheap goods from overseas that had dampened global price inflation will recede. One of the consequences of more home production instead of global free trade will be higher production costs. Conclusion. Someday, maybe not so far in the future, the accumulation of liquidity that has been going on will lead to price inflation. As the saying goes, if it keeps on raining, the levee is going to break. Government leaders and central bankers, not only in the United States, are about to make the same errors that were made in the 1970s when expansionist economic policies deepened and prolonged the stagflation. Now, we face the risk that things will get worse than 50 years ago. We must expect a more severe situation than a mild stagflation. Many economies around the world are heading for a slumpflation as they get mired into the morass of a deep slump and rising price inflation. Source: Anthony Mueller, Heading Toward the Morass of Slumpflation.
Medium June 13, 2020 https://medium.com/@Anthony Müller